Well, 2025 was a year that definitely caught a lot of people by surprise. So today we're going to unpack exactly what happened and, more importantly, we're going to look at the historical patterns that could give us a bit of an edge navigating 2026.
Okay, let's just dive right in. If I told you at the start of 2025 that the absolute best performing assets were going to be things like gold miners and copper, and that the top performing country fund would be Peru, would you believe me? Yeah, probably not. And that's exactly why we're here, to dig into the historical patterns that can help us anticipate the surprises of 2026.
Before we can look forward, we really need to understand the terrain we just crossed. So let's take a closer look at the wild ride that was 2025, starting with the big indexes.
At a quick glance, the broad market looked pretty strong. The S&P 500 delivered a really solid 17% return. That's a great year, right? But that's just scratching the surface. If you zoom in a little bit, you'll see that tech-heavy NASDAQ 100 did even better, climbing an impressive 21%. So you'd think the story was all about big tech, wouldn't you?
Well, not quite. The real engine room was even more specific. It was the semiconductor index, which absolutely blasted off, rocketing up an incredible 43%. This one slice of the market powered a huge portion of the year's gains.
But here's the real kicker. Even with those huge index numbers, trying to pick individual stocks, it was like navigating a minefield. The top performers weren't the names everyone was talking about. We saw companies like SanDisk and Western Digital just soar, while popular growth stocks like Lululemon actually lost money for the year. Crazy, right? And this theme of the unexpected didn't just stop with stocks. When we broaden our view to, everything, the winners were even more surprising. It was all about metals. Gold miners, silver, copper, they led the pack. And in terms of countries, get this, Peru was the absolute standout with a massive 76% return.
This all points to a really crucial market idea called reversion to the mean. In simple terms, what goes way up often comes back down to earth, and what's been beaten down can have a surprising recovery. The big lesson from 2025 is that the market is always rotating. What was hot yesterday is rarely what's hot tomorrow.
So, with that lesson in our back pocket, let's pivot from looking back to looking forward. There's a key seasonal event that kind of acts as a bridge between the old year and the new, and it could give us our first real clues for 2026.
Now, you've almost certainly heard the term Santa Claus Rally, right? But what exactly is it? The definition is actually very specific, and it's really important we're all on the same page here.
And there it is. It's not the entire month of December. The Santa Claus Rally is technically the final 5 trading days of December, plus the first 2 trading days of January. This very specific 7-day window has a fascinating history of being a really positive period for the market.
Now, this rally is way more than just a quaint holiday tradition. It's actually the first piece of a super powerful predictive tool for the year ahead, something the source material calls the January Trifecta.
Okay, so the January Trifecta is a historical indicator based on 3 simple conditions. Ready? 1. The Santa Claus Rally we just defined is positive. 2. The first 5 trading days of the new year are up. And 3. The entire month of January finishes in the green. Simple as that.
And here's why this trifecta is so powerful. Just look at the historical data. When all 3 of those conditions have been met, the S&P 500 has finished the year higher a staggering 90% of the time. But if even one of those conditions fails, the win rate plummets to just 60%. That is a massive difference.
But wait, there's another crucial layer to our 2026 outlook. It's a midterm election year in the US, and these years tend to march to the beat of their own very distinct historical drum.
Before we dive into that pattern, I love this quote from the source because it really sets the right mindset. This isn't about gazing into a crystal ball and predicting the future. It's about using history to anticipate a range of possibilities so we can be prepared for whatever the market decides to throw at us.
So this is the typical roadmap for a midterm year, based on data going back decades. It often starts out a little weak, finds a peak around spring, and then just kind of slogs through a difficult summer and early fall. But the key takeaway here is that for those with patience, the real payoff has historically shown up in that 4th quarter.
All right, so we've reviewed the surprising past, and we've examined the historical patterns for the future. So let's bring it all home. What are the key signals to be watching for right now as we head into the end of the year?
The source material points to 3 key pieces of evidence that suggest a year-end rally is pretty likely. First, options data, which is basically how traders are placing their bets for the future, is leaning bullish. Second, the market just had a healthy, minor pullback, which can act like a coiled spring for the next move up. And third, overall market sentiment isn't showing extreme greed. And that's important because when everyone gets greedy, it's often a sign to be cautious. Right now, things are more neutral. So what's the bottom line from all this data combined? It's pretty direct. The evidence suggests this is probably not the time to be betting against the market. Now, being cautious or on the sidelines might be smart, but making active bets that the market will fall, what's known as going short, carries a lot of risk right now. And that brings us to our final thought. We've laid out the January Trifecta and the Midterm Year Roadmap. Now, these aren't crystal balls, but they are powerful historical guides. So my question to you is, now that you know these patterns, what will you personally be watching for as 2026 kicks off?